Hello everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. Today we are talking about insurance, and this is one of many videos I've already done on insurance related topics. So if you haven't done so, please do check out our insurance folder. There's quite a lot of videos there, ranging from just understanding the basics of life covers, why it's critical, how to seed that life cover to act as credit life. And I've also done a debrief of a Q&A I did on my Instagram page as part of my Money Quiz Friday. So please do check out, because I believe that folder will help you a lot in just gaining an understanding of the insurance business in general. So today here I want to discuss how you can actually save money by making sure that you are revising your insurance yearly, to the extent that the insurance is actually linked to a depreciable asset, meaning an asset that actually loses value year on year. So what I want you to understand is that insurance is sort of based on two things. The premium that you pay is determined by the risk profile of that which you are insuring, and obviously the value at which you are insuring. So the risk profile is how likely is that event that you are insuring likely to happen. So let's take a typical example of insuring your house against fire or flood, and again insuring your cell phone against theft. Because you carry your phone around, you go to places where there are potentially thieves, etc., etc., there's a high chance that your phone gets stolen when compared to a chance that your house get burned out or your house get flooded. So because of that, the risk premium associated with a high risk asset is likely to be higher compared to a low risk asset. That is where the risk profile comes in. And then when it comes to sort of like lifestyle or life insurance, they obviously look at your health, they look at the occupation in which you work, they look at your age. So if you are younger, you are healthy, you don't work in a high risk job, you are considered low likely to die than someone that's old, that works in a dangerous career, and someone that maybe has a health issues. So that's how they actually evaluate risk profile to associate the premium that they would charge you. So that's the first thing. The second thing is the market value, or the agreed amount that you want to be covered for. So for many items such as houses, phones, cars, there is determined market value. So they'll just value that item that you're trying to insure, and they will say, for the item of this type, we are only prepared to actually cover it for X amount of money. Whereas for your life, you determine yourself how much you want to be covered for, because there is no market price for a life. So it's dependent on how much money you earn, how many dependents you have, what your debt commitment are, and what you want to leave for your family when you die. So there isn't a market value for life insurance, but there's a market value for a lot of this other insurance. Okay, so what normally happens is insurance is going to pay you, in terms of the life insurance, what you agreed that they need to pay you, but for all these other things, they will pay you the value of the item at the time of the event happening. So let's just take a typical example. You buy a car and it was worth 800,000, and because of that they calculated insurance to be about, let's just say 2.7, and you drove that car for 3 years, and in year 3 you had an accident. At the time, your car is no longer worth the original price. It's now all of a sudden only worth 500,000. So insurance is not going to say, no, we're going to pay you the market value at the time you took the insurance out. They will pay you the market value of the car at the time the accident is happening. And because of that, it makes no sense for you to be paying the 2.7, which is a premium that was based on the original price. So as your car depreciates in value, logically your insurance premium is also supposed to be decreasing. But sometimes if you don't go to the insurance company and ask for this revision, they might not even do it. For some of them, because obviously the industry is getting competitive, I've seen some of the insurance company automatically reducing your insurance as the value of the car decreases. But for most companies, they don't do it unless you deliberately go there and ask for a revision of insurance in order to lower your premium. So you should be saving some money by basically just going to the insurance company and asking them and telling them, because my car is worthless, may I please start paying less for my insurance? So I today want to just discuss the process that I went through to revise my phone insurance. So I bought the iPhone cash last year. It was quite a very expensive phone, and I wasn't prepared to lose it without actually having it covered. So I took out the insurance, but because obviously it's a phone, it was also a brand new model, the price was a little bit pricier. I felt like the insurance was slightly expensive, so I was looking for the price to start dropping so that I can go back to the insurance company and tell them, look, my phone has decreased in value and please revise my insurance. So what is the process that I followed to get a revision, and what was the outcome of that revision that I did? So I obviously called up my broker and said, listen, I would like to revise my insurance because my phone has decreased in value. Please let me know what the process is. And then he replied to my email and said I must submit photos of my phone, front view and back view, so that they can actually see that I still have the phone. And the reason for the front view is just for them, I was required to take a screenshot that shows today's date and the time at which I'm screenshotting that, so that they can actually see I'm taking those pictures today and not some pictures I have saved previously. So they just to corroborate that you still have the phone and it's not old pictures. I also screenshotted the serial number, so I had to go in settings, screenshot the serial number for them to actually also prove that the pictures that I'm sending relates to the phone that was actually insured. And obviously they would then take those photographs and then probably match it to the initial information that I submitted, the color of the phone, the serial number, etc. And then I also had to provide the valuation of the phone at the time. So I don't know for your type of phone if there's a second-hand market, but I was quite impressed to see that there's quite a decent second-hand market for iPhones. So I just went on iStore Namibia. I looked for a similar phone, similar color and similar model, and then I actually saw the value of that, the value of my phone if I were to sell it today. So then I took that screenshot on the website. I also forwarded them the link if they wanted to go corroborate that I didn't make up the prices, and then I forwarded it to them. So obviously they then forward it to the evaluator. The evaluator puts it in the system and the system throws it, for this value this phone should only be worth this much. And I was actually surprised. I saved $93 on my insurance premium. That equates about 8% on the previous premium that I was paying. So all I'm trying to say is that because the asset is depreciating in value, you cannot be paying yesterday's premium on a low value asset. So if you have a car, this is a simple saving because the phone is sort of low value. But if you start talking about cars and other big value items, you could be saving a couple of hundred over monthly, and if you multiply that, it can actually equate to a bit of bigger savings. Yes, that's all I had really from this short video. I just wanted to remind you guys that you should be revising your insurance yearly. On a similar token, you should also be revising other insurance to see if you are adequately provided for. So like I've mentioned in my Q&A Instagram video, I said that if you maybe perhaps get married, get kids, you need to assess whether the cover that you currently have is adequate for the dependent that are now increasing. And if you conclude that the cover is not adequate, then you might want to increase the cover. So like any other thing, insurance is constantly evolving, values of items are constantly changing, risk profiles are changing, dependents are changing. So you shouldn't do it once and then just park it there. You should really be evaluating so that you are comfortable that at any point in time what you are insuring is reflective of what you want to happen when that insured event eventually happens. Other than that, that's all I had from today's video. Thank you so much for joining us, and if you haven't done so, please consider subscribing, give us a thumbs up if you enjoyed this video, and until next time, it is goodbye.